Welcome to Totum, the Totum Risk Questionnaire. To get started, you would log in and you would see your overall dashboard here. You could add clients, or if you had some clients in here, you could select or search by client. In the profile settings, you could upload your company logo and your contact information. Profile settings are up here. You could also add your model portfolios. In the questionnaire tab, you can edit your add your own custom questions. We do not score them, but they are available here. In our questionnaire, there are 11 questions. The 12th question is not scored. It's based on their top 3 financial goals, and we'll get into that a little bit in a second here. In the questionnaire, if I go into a client or add a client, I would have them here. So from here, I would say Jody Lynn Country has not taken the questionnaire. You can see there's no scores here. So I could build a custom model, select one of the models here, or import a portfolio for Jody Lynn Country. To take the questionnaire, I would select questionnaire here on the right. We do timestamp and archive all questionnaires, whether they are complete or incomplete, and then you can review them year over year. Here on the right, I would select compare to look at year over year, or if I have a husband and wife take the questionnaire, I can do that as well. The only difference in the questionnaire would be the preference score would be different if a husband and wife were to take a risk capacity score will be the same. To send the questionnaire out, you could send out our full questionnaire or the short questionnaire. So the full questionnaire is just more detailed, drawn out questions. And then the short questionnaire is more for mobile devices. So we found that 65% of investors were taking the questionnaire via their mobile phone. So we made it easier for you to send out that questionnaire. Same robust, deep back-end models built by PhDs that have been in the industry for 30 years. And then from here, you could send out that questionnaire directly, copy the link into an email to make it more personal, or take the questionnaire with the client. So today we'll finish taking the questionnaire. It'll say resume. So to resume this questionnaire, age and income, pretty straightforward. How many people in the immediate household, and then number of kids or dependents. A lot of questionnaires just show or ask about the number of household. I have 2 kids. They're not free. They do impact my investments every day. So we do ask about dependents. Annual household expenses and their net worth. How much they would like to invest with you and what their time horizon is, whether it's short, intermediate, or long. And then retirement age. They could select whatever age they like. And then their zip code, where they live. 0016, and I own property. So again, we're making it very simple and relatable on the front end, but very robust on the back end with our deep quant models. We have up to 70 pages of quant documentation and models in the back end that are pulling data from multiple resources just on this questionnaire alone. So here we're getting more into risk capacity, but zip code data alone that we're pulling in, you have everything from cost of living index to real estate prices, and it gets pretty granular. We could get down to how much a Starbucks cost in the zip code of 10016 versus uptown or downtown or in the Bronx, right? Or over in Fort Wayne, Indiana. So again, a lot of detail behind here. So in this situation, you'd think because cost of living is high in New York City and real estate prices are high, the risk capacity would drop. And yes, that's true. But if they have a high net worth and they have low annual expenses and an average to above average median income, then the risk capacity could possibly stay the same or even go up, again, depending on all the data and how those numbers equate in the model. And from here, we want to find out if they what sectors they work in. So I would say I work in finance and then maybe healthcare. So we want to, what we're looking here is to make sure that they're diversified within the household, if they are in a cyclical or defensive sector, and if they're tied to one of the top 3 sectors in that zip code. So finance is the #1 sector in New York City. So here the risk capacity would drop. I mean, what we're worried about here is if we have another recession or a down market, this person could lose their bonus, not get the pay increase, or possibly even lose their job. And now we want to find out how consistent their income is over the next 12 months, because what we're trying to find in this questionnaire is how much are they willing to lose? What's the total potential loss that they're willing to take over a 12-month period for future returns? So here we want to see, is it they're guaranteed, is their income guaranteed? Will the pay likely increase over, but anything happen, or does it vary quite a bit? So you're looking at public sector, private sector, and then freelancer or consultant, or someone that is really tied to a commission or bonus only. And then one of the most important questions that no one asks in these risk assessments is health. And we know that 80% of US investors own the majority of the wealth out there. The age group that's 55 and older own 80% of the wealth. So from here, we want everyone to have great health, but if not, is it the head of the household, is it dependent, or is it both head of the household and dependent? And again, we're pulling in a lot of data in the back end to assess that risk capacity, whether it should stay the same, go up, or go down. Won't go up if I check yes, but what we're making sure is that we don't want to take on too much risk if we do have poor health. And then risk preference. Really, this is the only question we have to ask when it comes to risk preference. We found in research that we could ask 2 questions. We could ask 1,000 questions based on risk appetite or risk preference, and it's only going to change the outcome by about 5% after this question. So if I slide up and down here, I could find what my how much I'm willing to lose over that 12 months for longer term gains. And percent doesn't resonate, so we added the percent in the dollar amount. The dollar amount is what is really psychologically more important to us. So in this situation, I'm going to investing $500,000, and I'm willing to lose up to $100,000, which is 20% over that 12-month period. It's a little bit more aggressive. That's what we've seen during the bull market recently. And then the last 2 questions, we do ask 2 more questions based on preferences, because we do want to find out how much they're willing to lose today compared to the risk capacity, which is more based on facts and feelings. So looking at the Nobel Peace Prize winners from the late 40s, we want to flip the coin. So we're taking that 100,000 from the last question and rolling over it here, that if I gave you $100, you could walk away, or if we flip the coin, if it's heads, I'll give you $1,000. If it's tails, you get nothing. So we're taking that idea and rolling it here with this question with 100,000, and then flipping that question on the next, oh, sorry, I have to answer it. And then flipping it over to investment loss preference. So again, difficult question, but you need to ask it. And then the last question, again, your top 3 financial goals. We don't score this, but a lot of our clients have asked us to add it. And then the outcome, well, I'm sorry, I added a custom questionnaire. So do you currently have a financial plan? Again, this is where that would show up. If you don't ask any custom questions, nothing would show up here. And then finally, the outcome, they have a risk preference of a 53 and a risk capacity of a 79. So this is the risk preference is how much they're willing to lose over that 12-month period. But based on their life situation, they could take on more risk up to about a 79. And based on our information, we found that if the portfolio is closer to that 79, they're most likely going to achieve their financial goals. Again, we want to be in between these 2 risk scores, but again, closer to that 79. And then you would submit, the client or prospect would submit this, or if you take it with the client, they would submit it. And that's all that the client ever sees. And then it goes back to your dashboard, where you would see it's completed and timestamp and all the answers here. From here, you could download this to PDF and then share it with your client.